Good morning, students. Today we are starting a new chapter, chapter 48 from the A levels book, The Balance of Payment and Financial Account. Topic number 1, the Financial Account Introduction. So, we know that what is balance of payment? Balance of payment is a country's financial statement with the world recording all transaction. Balance of payment includes the receipts and the payments and receipts we get from the exports and payments from the imports. The balance of payment composed of three accounts: financial accounts, current account, and the capital account. Let's see number 1, the financial account. The financial account. What is financial account? Very first, let's understand. The financial account is a key part of the BOP, especially tracking money moving for investments and loans. Financial account actually records all the transactions related to the investments and loans coming in the business and coming in the economy or going out from the economy. Like, let's have one example. Germany 2019 data shows how direct and portfolio investments contribute to its financial account balance. What are the components of the financial account? As we know that financial account is the part of the BOP, and here financial account is further bifurcated into different components. Number 1, direct investment. Number 2, portfolio investment. Number 3, other investments. Number 4, reserve assets. Direct investment, long term physical assets, example building a factory abroad. Direct investment, we have seen many examples, like Google is making that data center in other country, or many car manufacturing companies are investing in other countries, like iPhone is making manufacturing mobile in India. So these type of investments are the direct investments. Portfolio investment, buying shares and bonds without gaining control. Portfolio investments means buying shares, just like uh, US government is buying, like Chinese government is buying US bonds, or Indian government is buying UK bonds. So this is the portfolio investments. Other investments like short term movements like bank loans and deposits, which is also called the hot money. Reserve assets, the fourth component. The central bank's holdings like gold, foreign currency to manage the exchange rate. Reserve assets means foreign reserves. Foreign reserves, which a central bank keeps in the economy to maintain the exchange rate. These are the components of the financial account: one, direct investment; portfolio investment; other investment; and reserve assets. If money is coming into the financial account, so it is a credit entry. If money is going out from the economy, so it is a debit entry. Number 2, capital account. So let's see the capital account, a smaller specific part of the BOP that handles non-produced and non-financial assets. Includes like transfer of ownership of fixed asset, Example, money brought in or taken out by migrants. So it is the part of the capital account. It also covers the intangible assets like copyrights, patents, trademark, and mineral rights. In BOP, we have three components like financial account, as I told you, capital account, and the current account. Okay, capital account, the current account, and the financial accounts are the most important one. The- So, since the balance of payment includes the exports and the imports, receipts and payments, and it contains three components, so there are chances of errors and omissions. So, this is a balancing item because if something is left, so we include it in a balancing item or a mathematical fix to ensure the BOP always balances, means the credit side is always equals to debit side. It is impossible to record millions of the transactions perfectly, as we know, because in accounting we have seen that there is always a room of error. So, in balance of payment, we always get the error, so we have to fix it with the net errors and omissions. Example, if all other accounts sum to minus 2 billion, so net errors will be plus 2 billion to make the total 0. Okay, so better data collection reduces the size of this figure over time. If they have a strict control over the receipts and payments, so definitely the BOP amount will be balanced. Understanding the financial account surplus. Surplus means extra. A financial account surplus occurs when more money for investments and loans flow into country than flow out. Okay, so there is inflow and outflow. Okay, so if inflow is greater than outflow, so it means surplus. It signals the strong foreign investor confidence in the economy, means when more money is flowing inside the economy, so it means that there is more confidence, and attracting multinational companies can boost jobs and income. This surplus can be used to finance a deficit on the current account, because if you have a deficit in the current account, so financial account surplus will help you to balance of payment, because all three all three contributes to balance of payment. Long term risk of surplus. The question is, surplus is always good for the uh, financial account surplus is always good for the economy. Let's see. Today's surplus can lead to future problems. How? Like money that flows in as an investment will eventually flow out as a profit. It is called a hole in a bucket, a leakage in the bucket. Means if someone is investing in your business, so definitely they will take out profit in the future. Example, South Africa. Past portfolio investment inflows led to a large outflow of interest, later causing a deficit on the primary income balance. This creates a direct link like financial account surplus now and later current account deficit. This is the problem. So what is happening here, that multinational companies are coming inside your country uh, and making a foreign direct investment of $1 billion, and we are very happy that they are creating job, but later they are sending profit outside the country to their home country, which is also called the leakage in the bucket. Policy approaches to imbalance. Two main policy approaches. Number one, expenditure switching policy and expenditure reducing policy. These policies are used to correct the imbalance of BOP. Remember. So, expenditure switching policy persuade people to swap foreign goods for local ones. Expenditure reducing policy get people to reduce their overall spending. So, the goal is to reduce the imports and increase the exports. So, expenditure switching policy means we motivate people to use the domestic products than the imported products. Expenditure reducing policy get people to reduce their overall spending. So, is it good to ask people to reduce their spending? No. Why they will listen us? India often runs a current account deficit. Main cause like high spending on the import of the oil leads to a deficit on the traded goods. So balancing factor like India has a large surplus on its trade in services, especially software exports. So this surplus helps them to balance the deficit. Policies must be targeted to specific costs like oil imports while supporting strengths to the service exports. Expenditure switching policy. Expenditure switching policies aim to redirect the spending from foreign produced goods to domestically produced goods. As I told you, the goal is not to reduce the total spending, just to change what people buy. We want people to buy the domestic product rather than the imported products. Intended impact like a fall in import spending, a rise in exports earning. So this will boost the economy. Tools and mechanism like government uses several tools to switch the spending. They use protectionism. They appreciate the exchange rate, and they use the supply side policy. How do they use the protectionism? Taxing imports, tariffs. So imports become very expensive, so people will switch to the domestic products. Exchange rate, lowering the currency value means depreciating the currency. Depreciating the currency means now you will see the imported products very expensive, exports will become cheaper, and imports will become expensive, which will force people to switch their spending. Supply side policy, investing in infrastructure to lower the production cost of the domestic goods. Investing in the infrastructure to lower the production cost, and as a result, the prices of the domestic goods will be lower because of the productivity. So these are the methods to reduce the or to switch the spending of the consumer: protectionism, exchange rate, and the supply side policy. Expenditure reducing policy. Expenditure reducing policy aim to lower the total level of spending in the economy. The logic is simple. If people have less money to spend overall, they naturally buy fewer imports. They can also boost export as the domestic firms seek sales abroad when local demand falls. Fiscal and the monetary tools like government and the central bank use two main set of tools. Like fiscal policy, the government can raise the taxes and cut its own spending. Number one is the fiscal policy. Number two is the monetary policy. Like the central bank can increase the interest rate to make borrowing more expensive, and saving will become more attractive. So people will consume more and save less. People will consume less and save more because of the high interest rate. Trade off, These policies can slow economic growth and increase the unemployment. Specific policies, effects, and the conflicts. Supply side versus protectionist effects. So there are two different switching strategies: supply side and the protectionist. Like supply side make local goods naturally better, cheaper through long-term investments, education and infrastructure. This takes time and success isn't guaranteed because supply side policy takes a lot of time. Let's consider the example of education. Like building new schools will help people to get more education, but consider how much time will they take to get past. They will graduate, they will do job, and then the problem will be solved. We have to wait a lot. Then protectionist force local goods to be the cheaper option by penalizing the foreign goods with the tariffs. This can be used for quick impact on the deficit. But there is a problem: it can cause retaliation from other countries. Unintended consequences. Sometimes fixing one economic problem creates another. Like policy conflict example. A government lowers income tax to reduce the unemployment. But what happens? People have more money, so they spend more. This help creates jobs. Unintended result, like some of that extra spending goes on import, which can worsen the current account deficit. So government lowers the taxes to increase the employment. So when they have money, so they spend some of their money on the imports, which causes the current account deficit. The financial accounts tracks the international investment loans, and a surplus brings the foreign capital but can lead to future profit outflows. Uh, the thing which is important to understand here is the effects and limitation. Effects and limitation of each policy. Just try to listen 5 minutes more. So effects of the expenditure switching policy, like exports become cheaper and demand increases, imports become expensive and import demand decreases, improves the current account according to Marshall-Lerner condition if Marshall-Lerner condition is satisfied. Limitation, for limitation of expenditure switching policy. Imported inflation may not work if it may not work if demand for exports and imports is price inelastic. Remember, these are the evaluation points. Protectionist policies like tariffs and the quotas can be used, but effects are it will reduce the imports and improve the trade balance. But limitations are retaliation by other countries, higher prices from the consumers, and inefficiencies in the region. Expenditure reducing policies. If we will ask people to reduce their spending, so it will affect the national income, import demand will decrease, and it will improve the current account. But limitation is may cause unemployment and it will slower the economic growth. So this is the end of the lecture. Please read the book very carefully.